Hi guys, today we will be looking at incidence of tax, how to illustrate when consumers or producers bear a greater burden, and when we need to use these diagrams. Okay, let's begin. Before we begin, you need to understand that the tax that we are talking about here are indirect taxes, otherwise known as taxes on certain goods and services such as alcohol or cigarettes. So what these kind of taxes does is that it increases the cost of production for producers such that it causes the supply curve of these goods and services to shift leftwards, which means that supply of these goods and services has actually fallen. So in the diagram, you notice that because of this leftward shift of the supply curve, prices is now higher from P to P prime, and quantity that's traded is now lower from Q to Q prime. Since the blue supply curve represents the supply before the tax was imposed, whereas the pink supply curve represents the supply after the tax is imposed, it means that the difference between these two curves, the vertical distance, must represent the tax per unit that was imposed on the good. Okay, so now you notice that there are two different prices that's represented on this diagram, P prime and P double prime. What do these two prices represent? P prime is actually the price that is paid by consumers after the tax is imposed. But does this mean that producers actually receive P prime? No, they do not, because even after receiving the price P prime, they have to pay the tax per unit to the government, which means that essentially producers only receive P double prime, which is the price received by producers after the tax is imposed, after accounting for the tax that they have to pay the government for every unit of the good that they sell. So how do we figure out who bears a greater burden of this tax per unit? You notice that while the tax per unit is given by the length of the blue arrow, but you realize that prices only increased for consumers from P to P prime by a distance that is smaller than the tax per unit. So therefore, this tax per unit is actually shared as a burden between consumers and producers. Consumers will bear a greater burden of this tax imposed if the demand for the good is more price inelastic than supply of it. Before we go into the intuition behind why this is the case, let's look at how this is represented in the diagram. Now, for consumers, how do we figure out what is the total tax burden that they have to bear? We look at the increase in prices for consumers from P to P prime multiplied by the new quantity that is being traded in the market after the tax is imposed. So the new quantity that's been traded is now Q prime, which means that for consumers, the burden of the tax that they have to bear must be equivalent to the yellow rectangle. Once again, consumers bear the burden of the tax in terms of the price increase that they see. And the total tax burden that consumers bear will be the difference between P prime and P multiplied by the new quantity that's traded, which is Q prime. Similarly, for producers, the burden of the tax that they bear will be the difference between P and P double prime multiplied by the new quantity that's traded, which is Q prime, and that's given by the purple area. Now, the intuition behind this is actually quite simple. Why is it that consumers bear a greater burden of the tax imposed when the demand is more price inelastic than supply? Because when demand is more price inelastic than supply, this represents that consumers, as compared to producers, consumers are not as responsive to price changes as producers are. Therefore, when the tax is imposed, producers are able to pass on more of this tax to consumers in the form of higher prices, since consumers are not as responsive to price changes anyway. Now let's look at a situation when producers bear a greater burden of the tax imposed. So similarly, now the indirect taxes again shifts the supply curve leftwards from SS to SS prime, and again there is an increase in prices from P to P prime, so on and so forth, and then you notice that the difference between the two supply curves again illustrates the tax per unit that's been imposed, and the price that is received by the price that is paid by consumers after the tax is imposed is P prime. The price that's received by producers after the tax is imposed is P double prime. So you notice that the difference between this diagram and the previous diagram is that in this diagram, we're trying to illustrate that the supply of this good is more price inelastic than the demand of this good. So therefore, again, you notice that the tax burden borne by consumers is actually given by the yellow area, and the tax burden as borne by producers is given by the purple area. Again, the same intuition applies behind this diagram. Why is it that producers bear a greater burden of a tax imposed when the supply of a good is more price inelastic than the demand for it? Because this means that consumers are more responsive to price changes than producers are. So if consumers are more responsive to price changes than producers are, this means that producers will not be able to pass on more of this tax imposed onto consumers in the form of higher prices, since consumers are very responsive to price changes and they will cut back on quantity demanded more than proportionately given a price change. So when do we use these diagrams? We use these diagrams to illustrate tax burden on consumers versus producers when there is an increase in cost of production or when there is a tax imposed. So you need to understand that such diagrams are not just limited to illustrating tax incidence, but also the incidence of any increase in cost of production of a good. So if you remember in tutorial, there was actually a question about increase in prices of crude oil and how that has affected the market of petrol. So in that question, we were also able to use these diagrams to analyze whether consumers or producers of petrol bear a greater burden. Okay, so these are the situations whereby we use these diagrams. Alright, this is the end of the video. Good luck for your mid-year exams and I'll see you in the next video.